All right, guys, welcome back to another video. Today I'm going to be doing a market update for Oshawa and Oshawa real estate. Essentially what I want to do is go through some of the important things that we're hearing in the market in terms of news, and then we'll get right into numbers and see how the market has performed in the month of November. Recently, there's been a lot of news and a lot of talk about the interest rate hikes. And as you can see here on the screen, I have screenshots of the newspapers and the broadcasting companies talking about essentially interest rate hikes. So Bank of Canada holds interest rates. No need to hike the benchmark interest rate just yet. Bank of Canada holds on the rates. Market versus Bank of Canada, who will prove to be right. So we know that throughout COVID, interest rates have been dropping very low, and as a result, the fixed rate and the variable interest rate have been very low as 0.99%. And what this has done is given people more buying power to go out and purchase properties. And when you couple that with the supply and demand, so there's very low supply and high demand coupled with low interest rates, we've seen an increase in price. So essentially that's created a real estate bubble, and a lot of people are talking about what's going to happen with this bubble. Are prices getting out of hand and whatnot? So this news had to do with the interest rate hikes. So there was mention that the Bank of Canada may raise interest rate hikes, may raise interest rates, and as a result, that would reduce people's affordability factor. So we see that the Bank of Canada has said not yet, and as you can see in this article, it says still sees hike in the middle of next year. So we know that they're coming, but we're just not sure when. If we take a look at what RBC has published today, their 5-year fixed rate has increased to 3%, which is a high interest rate compared to what we've seen in 2020 and 2019. So this is an indication that the fixed rates are going up, and as a result, people will be able to afford less when it comes to purchasing their property. So the 5-year fixed rate is not a surprise, because if we take a look at essentially the 5-year bond yield rates, we can see that since 2021, September of 2021, that bond rate has been increasing, which would indicate to us that the 5-year fixed rate would be increasing as well. So not a surprise there. But if we look at the data starting in 2001 and essentially until 2021, we'll notice that every time there's a hike in the 5-year bond yield rate, it follows with a decrease. So this is essentially related to the real estate cycle and the interest rate cycles. In the event that there's a hike, it subsequently drops down slowly. So essentially what we want to just talk to people about is that, you know, if you're in a 5-year fixed rate right now, you're likely okay, because if you've purchased in 2020, 2021, you still have another 4 to 3 years left on the term of your mortgage. So you wouldn't be really impacted by this too much. But if you're a new buyer getting into the market now, this is going to have an impact on your affordability factor. Now, what does this mean when interest rates hike? So essentially what you should be doing is you should be doing an analysis on your property now and how it's performing now and how your property will perform in the event that there's an interest rate hike. And we know that interest rate hikes are coming, as we saw in the articles, in mid-2022. So you need to be ready and aware of how your property is going to perform, whether it's your principal residence or your investment property. So how's your property performing now? A couple of things you want to do is you want to take a look at your current rents. You want to make sure that your rents are at fair market value. And if they're not, you need to know, you need to be prepared to provide your tenants with the rent increase for 2022. So we know that for 2022, you can do a 1.2% rent increase. And in order to do that, you need to provide your tenants with the N1 form just to make sure all your bases are covered. And you need to essentially take a look at your property now and see how much cash flow are you generating. If you have enough cash flow, that means that in the event that there's an interest rate hike, you should be protected because you have cash flow, you do have the ability to pay a bit more towards interest. And yes, in return that will reduce your cash flow, but assuming you're not going into a negative position, you should be covered well. So essentially, the key takeaway here is that you need to know how your property will perform in the event that there is an interest rate hike, and the way you can do that is essentially take your property now, change the interest rate on your mortgage, and see what that does to your cash flow. So let's jump right into the numbers. So in this chart, we're looking at new sales, months of inventory, average price, and days on market. So we're in the month of November, and essentially what we're seeing here is the seasonality. So we have less new listings coming onto market. So in November of 2021, we had 324 listings coming into market, which is lower than essentially the months of August, September, October. And as you can see, prices have increased as well. So our November average sales price was $862,000, which essentially, if we look at new listings, we talked about the supply and demand issue, and here the narrative is that since August, the supply went up in September, but in the following months of October and November, it's dropped down. So less supply means that prices are going to rise, and as a result, we can see that in August, our average price was $772,000, and now we're at $862,000, so nearly $100K over. So if we take a look at a month-over-month rate, so from October to November, we're up 1%. And from August to November, we're up 12%. So that's fairly dramatic. And even if we go back to January, we see that we are, almost 15% increase from January till November of now. So if you've made a purchase, you've likely made some money. What you can do is you can try and tap into this equity with a home equity line of credit, or refinance if you're on a variable mortgage. This chart here just shows us the supply and demand, and essentially showing that it's again pointing back to seasonality. Right now we're in November, and as you can see that the new listings are dropping off, and in the new year we should be seeing an increase in supply. So typically around March, April, May, those are the months where the winter's starting to slow down, snow's starting to go away, and people are prepping to sell their homes for the summer and be settled by the summer. So seeing low supply now is normal, and we would expect that to rise in the new year. So with that said, essentially, I want to make sure that everyone's up to speed. So if you have any questions with the market and how the market's performing right now, feel free to get in contact with me. You can reach out to me via my social media, or you can give me a phone call at 905-449-4242, or you can schedule a call with me with my Calendly link. So feel free to get in contact with me with any questions that you have regarding the Oshawa market.